We have Rahul Ghose of Hedge.in who's joining us on the show right now. Rahul has given us some very comprehensive strategies to work with, especially keeping the first week of June in mind. Rahul, good morning. Thanks for joining in. What's in store now? If you could give us an update about how you're reading markets at the moment, because not really, not much has changed except for the fact that we've seen the Nifty make a new high and then retrace, take a step back to a certain extent. What's the way forward now?
Good morning and thank you for having me. So firstly, we're talking about our previous strategies, just to inform all viewers that the last two strategies paid off very well. They were on the bullish side, and when Nifty went to 23,000, all those strategies paid handsome dividends. Coming specifically with respect to index now, it's very interesting. If you notice the kind of positions the bigger hands are creating for the election, you'll notice that there is a concentration at 23,000 like you were showing. So 23,000 straddles are being created of the June end expiry. But very interestingly, the offsets of that 23,000 short straddle is June of 22,000 and 24,000, but is also of July 22,000 put and 24,000 call. Now, what this essentially indicates is that they're not expecting more than 1,000-point gap on either side, which is one side of the story. But the second part of the story is that they're expecting volatility in the second half of June or in the month of July, which is very interesting. That is that the big event might not cause a big move, but the follow-on can cause a big move. And when I say big move, they mean 1,000 points on either side. So that is the popular consensus of big players currently going in now. The tinge is still on the bullish side, so the strategy we would suggest would still be on the bullish side today.
Rahul, what kind of an option structure are you looking to deploy in markets like these?
So we're going to keep it fairly simple once again and not go for 3 and 4 legs. We're going to do a bull calendar call. And we're going to do it once Nifty gaps down today about 50, 70 or 90 points as it currently suggests. So what we're going to do is we're going to buy the 23,200 call of June end expiry, which is trading around 400 rupees. Currently, it should be about 360, 370 with the gap down. And we're going to sell simultaneously the 23,500 call of 6th June, which is currently trading around 180 odd rupees and which might trade lower once the gap down happens. The strategy is completely protected because 50% of the credit you're getting right in the first week of June. Now you have 3 more expiries to keep selling calls and getting more credit. And if the market moves forward or upside beyond 23,900, I beg your pardon, 22,900, anywhere in the June series, the strategy starts paying dividends. So buy 23,200 end June, sell 23,500 of 6th June, a bull calendar call. Risk is small, as you can see, about 1,500 odd rupees, and the reward can be handsome depending on where Nifty closes on 6th of June.
For the sake of all those who are new in the options market, can you give us a further idea about the differential of implied volatilities in the 6th of June and the subsequent expiries?
So implied volatility or IV affects closer by strikes more than further away strikes. That is the first thing you need to keep in mind, or the viewers need to keep in mind. But the advantage of selling the 6th and buying the 27th is that the 6th is going to expire much faster than the 27th, because of which 27th would still have a lot of time value left because it's out of the money and there's still a whole month left. But the 6th, in case markets don't go up or remain sideways or moves to the downside, would straight go to zero because it is far out of the money. Why have we taken out of the money strikes could be a question to your viewers. The reason for taking out of the money strikes is so that the buy and sell legs come close to 50% of the net debit paid. That is why we've gone to out of the money. And historically, if you do a statistical analysis, you will notice that whenever you have 50% of the debit credited to you in the very first week, the chances of success significantly move higher.
A final question then, Rahul, when it comes to this specific option structure, one, at what point in time are you making exits towards profitability, towards loss? And also in terms of time, are you moving out on a Wednesday before the weekly options expiry? Are you waiting out all the way through expiry? How are you making those exits based on time?
So 2 ways in which you can exit this position. One, if you get about 2-3% by 6th, which is about 1 week, good return of 2-3% in a week. So you can take your exit. Secondly, what you can also do is, in case you don't get a favorable exit and you still see that there's been a good big bang up move and markets have crossed 23,000, you can lock in some profits or look for a higher profit by continuing to sell calls, because 23,500 will still go to zero even if markets are at 23,400. But when you sell the 13th June call, you will still get significant amount of premium over there. So ideally, you should look for about 2 to 3% before 6th June. You could look for higher percentages depending on if Nifty is above 23,000 or not uh, at the time of the first expiry. But yes, 6th June is where you should look to book your profits if the trajectory is towards the upside.
Fair enough. Rahul, thank you so much for joining us and taking us through your views on the markets, also explaining and going through this particular option structure that you have suggested.